Hello, everyone, and welcome to our January investment market update. Today, I'm delighted to be joined again by Janet Mui from RBC Brewin Dolphin. Hi, Janet, how are you?
Hi, Mike. Thanks for having me. Very well.
Good, good. Thanks for coming on again today. I think it's quite an interesting time actually for you to be coming back on. It was about 7, 8 months ago, middle of the year last year when you came. An awful lot's changed since we last spoke. I think we were talking about upcoming elections, US elections, and obviously we've seen quite a lot of change over the last few months. So, what I'll do, we've got your presentation. So, if everyone can just bear with me one moment while I bring that up.
Thank you. So you mentioned that, yeah, a lot has happened actually over the past 8 months or so. I think we get a bit more clarity actually on, of course, the election outcome and also growth and inflation, monetary policy. But of course, there's still a lot of uncertainty. So let me convey the key themes for 2025. So on this slide, you can see that we have three key macro themes for this year. And the first one is US exceptionalism. And that is really further turbo boost by the election of Donald Trump as president. I think markets are really excited about the potential tax cuts and the deregulation that may happen. And later on, I'll also show you some charts which really shows how the animal spirit has been reignited in the US, and accordingly, the US asset has outperformed other regions so far. And we do expect this outperformance to continue. On the other hand, I think markets recently have refocused a bit more on inflation. I think that's really also linked to the fact that the US economy is growing really strongly. And the fact is there could be more pro-growth measures that is coming into 2025. So if that's the case, then inflation could actually reaccelerate. And I think markets these days sound a bit more worried. And of course, if you throw in the potential for tariffs, that is, you know, further going to reinforce that inflationary concern. And I think markets are also focusing a lot more on the debt sustainability issues in the developed economies. And particularly, we're going to talk a little bit more on the UK, which the market has been scrutinizing the UK gilts in particular these days. So in terms of the third theme, which is unstoppable AI. So we actually have seen investments related to AI really have done very well in 2024. And we believe that there are still reasons why this theme can continue. But there are also some concerns such as market concentration and valuation. But generally, we think that we just cannot ignore AI. It is really a very key driver of the US equity market at the moment, and also we think for the next couple of years as well. So let's dive in deeper into these themes with some charts. So I mentioned at the beginning that the animal spirit has been reignited. So you can see from the next chart that there is plenty of evidence actually. So if you look at survey data, so this chart shows the NFIB Small Business Optimism Survey. And you can see that basically after the election, the business outlook of US small to mid businesses has skyrocketed. And it is actually the biggest monthly increase since record began. And interestingly, actually, the second largest monthly increase in the record is also related to Trump, but it's really about the first time that he was elected. So I think Trump really does represent this America First attitude that I think really is very crucial to help small business confidence. So aside from this survey, right, if you watch the recent earnings results from the leading American banks, the CEOs have commented that actually what they're seeing on the street is a lot of the businesses and business owners, CEOs, they actually have turned more constructive on the US economy. There is a kind of decisive change in the mood that they're very excited about the incoming Trump administration. And that is primarily really related to the measures and what he stands for, and of course the fundamentals of the US economy versus the other regions. So if you look at the next slide, right, that is what I have put into summary of the key aspects of US exceptionalism. So US exceptionalism is nothing new, basically. What we have seen pretty clearly that in the market, right, the US equity markets have outperformed the other regions significantly in the past decades, right? So this is nothing new. But what Trump 2.0 does is put it into further focus. So let's take a look at the growth, right? The growth currently in the US GDP growth is over 2%, and is expected to remain 2%, whereas the other economies are likely to grow at roughly half of that. In particular, productivity growth, as you can see, the US is growing at 2%. Look at where Europe is. They are contracting at the moment, and particularly the productivity growth in the UK is really just awful, right? This is really a huge difference between US and Europe. And if you look at the other surveys, like the Purchasing Manager Indices survey, US is strongly expanding, whereas Europe, they're either contracting or barely expanding.
So
In terms
Janet,
of
what are the main drivers behind that? What are the sort of main differences that you would suggest between? I mean, I know you've written down there tax and spend, political impasse, but
yeah.
is that really the only things that are driving the differences, or are there other things that are sort of playing into this?
So I think a lot is about the US being a more dynamic economy in general. They first of all, I think technology plays a huge role. Basically, if you talk about AI innovation, I think the country that you need to look at is really the US, right? I put it actually there below as a technology as a percentage of the stock index is
Huge.
like a third in the US. And it's just counting the technology. You're not talking about consumer discretionary, which also involves like Amazon. That is basically tech as well. So, the whole US is basically immersed in technological innovation, which helps drive productivity, right? As you can see, productivity growth is so much better. So I think that is one of the reasons why the US economy, economically and market-wise, is doing so much better than Europe. And I think the other thing is really the animal spirit as well, right? I mean, the animal spirit has been better in the US versus Europe. I think that is really important because in Europe, what we're seeing is perennial weakness in fixed investment. So of course, that is going to constrain growth in the longer term. And I think the other thing is the fiscal bias is as well. I think Europe is more about high tax and potentially some waste in that fiscal spend, which is not going into productive use. So I think these are really the fundamental differences. And also the US, they actually have better demographics as well. In the past couple of years, the reason why the US labor market has been able to generate so many jobs without huge wage pressure is because of very significant immigration. Now, this is, of course, a risk going forward with Trump's anti-immigration policy. But I think the demographics-wise, economic fundamentals, the animal spirit, the fiscal bias, the whole tech scene, it's just so much better in the US compared to Europe. So I would say broad market exposure-wise, we much prefer US relative to Europe. But that is not to say there's no good companies in Europe, for example, right? That is really a big misconception. We are less favorable on the market exposure to Europe, for example. But there are also great companies that actually export heavily to, say, the US or the ex-Europe. And there are still, of course, some handfuls of great technology companies in Europe, right? Or those that are benefiting from the huge defense spending, for example. So there are companies like that in Europe that you can still stock pick in the region. So I will say, don't be like blanket negative on, say, the UK and Europe. They're still good companies, but you just have to be a bit more picky. And generally, I think the broad market exposure, definitely US would be better than Europe, for example. So that is really a very key theme for us. So if you look at the next chart, right, I think a lot of that is very easily understandable, very consensus. We like US is great. And we still believe that we should have an overweight in our position in US. But the thing is that I don't think 2025 would be a straight line of market going up, because there are some concerns that are building. And I think a lot of that US exceptionalism is already built into market pricing. For example, if you look at the left-hand side chart, the forward PE of major equity indices, the US is way, way more expensive than the other regions. I think this is one reason why you still would like to diversify. So you don't want to put all your eggs into the US market, for example, because when other regions are cheap enough, there's always a potential for a rebound, right? When asset prices are too cheap. So we have to see basically Europe or UK, the valuation is basically about half that of the US equity market. So I think that is something to really bear in mind. And you see the US dollar index has been surging. Again, a lot of that US exceptionalism is already priced into that. It doesn't mean that it cannot, the US dollar cannot keep strengthening. It doesn't mean that US couldn't strengthen versus other region. It's just that there could be hiccups along the way because of how expensive things are, and we have to be careful of that, be mindful of that when we are investing. So the next theme, the next slide, I would like to talk about inflation, tariffs and deficit. So I mentioned that the market has recently shifted focus more on inflation, and rightly so, because although actually, if you look at this chart, the progress on inflation has been significant, right? We have a lot more clarity on inflation than we were 2 years ago, right? So we are closer to 2% than we ever were in the past 2 years. So that's great news. But the thing is, the last mile of that 2% inflation target and the sustainability of the 2% target is not that easy to come by, right? The reason why is because of various reasons, actually, quite different reasons between the US and the UK. I will say the US, you can say the worry is on the positive reasons. People worried about inflation risk because the economy is strong. And fundamentally, that is a good thing. You want the economy to be strong, right? But the thing is, going forward, because of Trump's anti-immigration policy and tariff policy, inflation could go a bit higher. So that is the main concern. But the problem is there is so much uncertainty surrounding these two elements. We just don't know how it is going to play out. So I think that uncertainty is reflected in the recent rise in bond yields. People are just worried about the potential for higher inflation, and therefore interest rates staying high for longer. But for the UK, it's entirely for the different reason. In the UK, people are worried about inflation, not because of growth being strong, but because of supply concerns, because of the government putting up a national insurance contribution, and therefore the idea that businesses will have to raise prices to offset those tax rises, and thereby you have a spiral going on, particularly if there are still labor shortages going on. So it is two different reasons for concerns on inflation, but the same consequences that bond yields are higher. But the difference is really the pound has weakened very sizably, and whereas the dollar has strengthened across all currencies. So I think,
Janet, does that mean that you think whilst today we found out that inflation has gone down to 2.5% in the UK, is it potentially are we potentially going to see increases again? So we might see a bit of a delay because obviously the dollar and the pound being weak against the dollar, energy prices, things like that. Are we going to see that filter through in the next month? So whilst at the moment there's been a bit of a sigh of relief in the UK government that inflation's dropped a little bit, and particularly in sort of service-led industries, which is an area they've been concerned around for the last couple of years. Is there a possibility that whilst the pound is still weak because they're concerned around growth in the UK, that we might still see some inflation imported because of the pound weakness?
Yeah. So I guess the weakness in the pound is more related to the overall pessimism on the UK economy and the fact that a lot of these borrowings are not going to translate into growth. But you're right. I think the market is worried about inflation because the thing is, the pound, as I said, weaker pound is going to raise imported prices. And what we see is that energy prices have actually been picking up, and there would be an increase in the energy price cap going forward. So all these suggest that actually we could see inflation picking back up again. And we still haven't seen the real effect of that increase in national insurance contribution. It hasn't even kickstarted yet. So I guess there's just a lot of uncertainty and a lot of gloominess surrounding the UK in general, right? And I've got the next slide, which shows the dilemma that is actually happening in the UK. I will say the Bank of England is having a very, very difficult job. Because as I said, the US, the inflation is because of strong economy. So it's easy for them to think, oh, we don't need to cut interest rates because the economy is strong. But that's exactly different from the UK because the thing is, on one hand, there is this concern over price pressure, but there is also a concern that growth is slowing, and there is big evidence that growth is slowing down. The recent GDP growth data suggests there's no growth at all coming in the fourth quarter, right? And this slide, what it shows is basically a survey on businesses, and they're expecting generally to lower their staff levels because of the budget. But at the same time, they expect that they have to increase prices to cover that or partially cover that NI increase. So you can see it's a very bad trade-off we're talking about here. You basically are talking about a potential stagflationary implication. And that is why the bond market in the UK has done worse than the other developed economies, for example. So that is really, really a tricky situation. And that is why, for the next slide, right, what we are seeing right now is that there has been a pickup in the bond yields generally in developed economies. As you can see from the left-hand side, it's not just a UK problem. A lot of people confused when they look at the news, they thought, oh, it's totally attributable to the budget. It's actually not. It is a global phenomenon. You can see the US bond yields have picked up just as much as the UK because people are worried about inflation. But as I said, it's a completely different driver. The US, they're worried about strong growth, but is it really too bad? That's not too bad a thing to worry about, actually. But in the UK, we have weaker growth dynamics. We are likely to grow just half the pace of the US in 2025. So why are we seeing such rise in bond yields? It's because people are worried about fiscal sustainability because they just don't have the confidence that all these borrowing from the budget is going to translate into growth. I think investors just don't have confidence on that. So in order to lend to the UK government, it is very natural for them to demand a higher rate of return from the UK government, right? So that is why we see that the bond yields in the UK has risen more than the US, for example. And this is likely going to be an ongoing theme going forward because what we think is that 2025, the market will constantly focus back on fiscal sustainability, not just in the UK, US as well, because Trump is proposing so much tax cuts, which he is only proposing to be financed by tariffs, right? But the problem is that the UK doesn't have that luxury of growth. The US, at least, they have growth, and Elon Musk is pledging to cut government spending to improve efficiency, but not so much of that is happening in the UK. So the UK, I think throughout 2025, the market will just come back again and again as bond vigilantes. On the other hand, that may not be a bad thing because we have to thank this bond vigilante because that is a mechanism for the UK government to be pressured into doing the right thing. Imagine if there's no bond vigilante, that the government has such a large majority, they can literally do whatever they want in terms of tax and spend. But because they are constrained by these higher borrowing costs, constrained by the market pressure, they would have to go back and do the right thing fiscally, which will eventually involve some form of maybe tax increases, which will break their promise, or some form of government spending cuts, or a bit of both as well.
So, Janet, just to pick up on a few things there, obviously the budget's had an impact, or we're not seeing the full impact of the budget with the national insurance rises, but it kind of feels to me that we're in this position where we've had very little growth in the UK in the last sort of 3 to 6 months. And whilst the tax rises that will be coming through will help support some of their pledges, if we're not seeing the growth that they were anticipating, then that really puts us in a bit of a downward spiral because the options then are tax more, try to raise more funds, so on and so forth, which could be a bad reaction from the market. So I guess they're in a bit of a position where if they're not careful, and you're right, you've got the bond vigilantes, they were there when Liz Truss was about a number of years ago. And that was a very big lesson learned there. And I know that the yields have gone back up to those sorts of levels, but under different reasons, as you've said. But I think it's an important point that there's going to be some changes this year that perhaps we weren't expecting. Either they're going to have to row back and look at different policies that might help growth, or they double down on tax rises, which could just actually make the problem worse. Is kind of a fair assessment, or have you got a different view on that at all?
That is a very fair assessment. I think that is why the markets would be constantly pessimistic about UK growth. It is just so difficult when you think about it. You can't borrow more, you have to tax more, or you have to cut spending. That is not going to generate better
Because
growth
there's a
at the end of the
point, isn't
day.
there? There is a point at which, whilst we all believe that there are places that people could pay more tax, there is a balance to be had. And there is a point where you increase the taxes, the tax burden, and it gets to the point where you receive less taxes than you would have done by increasing certain taxes. So it's a bit of a tightrope walk in some respects for them to have to go across. And I think so far what you're basically saying is, yes, there's been global factors in this, but 2025, the bond vigilantes are still going to be around,
Mm.
causing problems if they don't feel that the current government are actually they're saying they've got an agenda for growth, but the actions might not be supportive of that growth agenda.
No, I think markets just don't buy the idea that these policies will boost growth. And I
No,
think yes, and I think you're absolutely right. I think honestly, the best thing they can do is to cut unnecessary spending, excessive, unproductive spending, but it is way easier said than done. You don't have Elon Musk here in the UK,
no.
for example. It is very, very difficult. So I think the conclusion we can draw from all these is that UK growth will be weak. It's likely to be weak, stay weak, underperform the US. And actually, I think risk is building. We're not at the point where the taxes are kicking in yet, right? That is why I think there is potential for the Bank of England to eventually cut more than expected, because they may not want to do that, but at the end of the day, you see the latest data, right? GDP barely growing, inflation actually lower than expected, and the market already revised the expectation. They're now actually expecting the bank to cut in February. They wasn't
Yeah.
expecting that. They thought they couldn't because inflation is high, but at the end of the day, if growth is too weak, everyone is suffering, mortgage rates are going up when they shouldn't be, then their hands are tied. So markets actually reevaluated that the bank would have to cut instead of staying put. So now we turn to the fact that the conclusion that the UK, I think relative to the US, is more likely to see rate cuts this year, potentially as early as February. Yeah. That could, of course,
Brilliant.
help a bit with the bond yield situation as well. But generally, I think the idea is that bond yields could stay high for longer in 2025. But there is a possibility the Bank of England will cut more than market price. Yeah.
So only time is going to tell what happens there. But I
Yeah.
guess that sort of brings us on then to think a bit more about AI investment, because obviously that's
Yes.
a big area of interest and really took off last year. So I've just moved on to that slide for you now,
Yes.
Anna.
Yes. I think amid all of this, right? If you think about growth in a developed economy, right? US is definitely the bright spot. UK less so, Europe less so. And I already explained at the beginning how innovation plays a huge role in boosting productivity. And honestly, the US is where all these actions are happening. And what we see is that all these are not just hype. A lot of people they say AI is a hype. This is an AI bubble. But what we see is that these are backed by very strong, solid investment. It's not something um that is fake. It's not like a hot air, for example. This is real dollar spending,
So
right,
it
by the
can't be
biggest
compared. It,
companies.
it can't be compared to like previous times where people thought there were bubbles that were going to burst, or it was just
Exactly.
a complete, um, just fallacy that this was going to go anywhere. So yeah, there's a lot behind there, isn't there? And it's grown off of a really solid base as well. So I think it's quite impressive to see how AI will. And I think the way we're looking at it here within our own business is it's a support, it's a co-pilot, it's an aid, it's not a replacement. And there's a lot of power in utilizing it in the right way.
Yeah, absolutely. And what we see is basically the AI investment is still growing and growing. And I think if you look at the left-hand side chart, 2025 expected capital spending by big tech companies, 200 billion. I think actually that is likely to be revised up further given the recent announcements from companies. And the right-hand side chart, you can see these revenues are real. So if you look at the solid part of the line, those are actual revenues, not the forecasted one. The forecasted one are still going up, but the actual ones have actually been growing very substantially, particularly in the semiconductor sector. So these are all real. And just today, we saw the latest earnings forecast and outlook from Taiwan Semiconductor Company, which is basically the biggest AI chip producer in the world, the most systemically important company in the world potentially. And they're saying AI spending investment is still very, very strong. So this is something that is unlikely to stop anytime soon. A lot of experts, so not coming from me, I'm not an AI expert, but I do listen to a lot of experts, and they're all saying we are really at the early stages of that AI beginning. So if you look at the next slide, right? As you mentioned, you say this is going to be a co-pilot. I think a lot of people probably think so. And the thing is, actually, currently, the share of US companies using AI is still relatively low. This is a chart by Goldman Sachs, right? They actually think just around 6% of companies are using AI. Obviously, there's a different variation in the industry itself. Of course, the tech industry uses more AI, whereas accommodation, food service probably not as much at this stage. But the thing is, with the percentage of companies using AI being so low to start with, you can see there's just so much potential to grow. You can really think of a lot of utilization of AI, basically to improve productivity, improve competitiveness, just makes things easier. And interestingly, actually, Goldman Sachs recently, they have published the latest chart in the outlook. And what they find interesting is that the share of US companies using AI has been growing in the last year or so, particularly around large companies. Of course, large companies would have the biggest wallet to spend on improving their systems and building AI models and things like that. And those are companies that have seen actually quite a big increase in the AI adoption. So I find that very interesting. And there's certainly a lot of room for that to improve. So that's why we think that AI is still going to be a very important theme. And of course, when you think about the companies that are exposed to AI, let's move to the last slide. The Magnificent Seven. Actually, if you think about Magnificent Seven, these 7 companies, their total market cap is bigger than basically the next 6 countries combined, aside from the US, right? NVIDIA, 3 trillion market cap, Apple, 3 trillion market cap. That's already about the size of the whole UK equity market when you think about it. So these are really, really important companies that we can't ignore. And they are the biggest constituents of the US equity market. And they drive basically more than half of the market cap gain in the US in 2024. Very, very important. And if you're bullish on these companies, then fair enough. I think it is fair enough to be bullish about the US equity market, actually. And of course, the MSCI World, where over 70% of the weight is in US. But that is a problem in itself, I have to say. So we are positive. We are positive on AI, positive on semiconductor. We like the Mag 7. We like the outlook. There's no doubt about it, right? These are the really great companies exposed to secular growth and have great competitive advantage. But the problem is that they're expensive. And also, a lot of focus is on the market concentration of these companies. If you look at the right-hand side chart, the Mag 7 is now 34.6% of the S&P 500 index. To be fair, these companies are great, and as long as they deliver good corporate earnings growth and things like that, there's no problem with them being so big. Of course, if they're good companies, they grow their market size, fair enough, they're a bigger share. But the problem with having such a high market concentration is that the whole index can fluctuate along with these stocks. Particularly, say, NVIDIA is a very volatile stock. Semiconductor stocks in general are very, very cyclical in nature. So imagine if you have these stocks being a huge constituent of the S&P 500. Are you really getting as much diversification as you think you are? Probably not. So this is one of the things that you have to bear in mind as investors in the US. When you buy the index, are you actually getting as much diversification as you want? So this is something really to bear in mind. It doesn't change the thesis of positive US equities, positive on AI, but investors just have to be a bit more mindful. And that's why even though we're in a world of US exceptionalism, it is still important to consider diversification broadly speaking. Maybe look a bit outside of Mag 7 in your portfolio. Look into the European companies that are great but have been oversold that still has reasonable and cheap valuation, for example. So overall, I think to conclude, right, 2025 is still a good environment for investing, and we believe generally the world index will still be up. I think our capital market colleagues are thinking the US equity index could rise by another 10% in 2025, for instance. Obviously, that could be bumps along the way. As we have seen in 2024, nothing moves in a straight line. The bumps could be because of concerns on tariff, concerns on valuation. There could be potential disappointment during the earnings season, etc. We've seen all that in 2024. But I broadly believe the markets will keep grinding higher because, first of all, the US economy is going to be still solid. As long as we don't see the recession, that's the biggest risk, right? As long as we don't see that the markets can grind higher. Secondly, interest rates likely to stay higher, but that is not going to be a huge headwind for the US. The US has proven to stay robust, even though interest rates were as high as 5.5%, right? So the room for rate cuts will be higher in the UK and the Euro area where growth is weaker. So you can also say that that is a bit of offset, right? If the central banks were able to cut in the UK and Europe, that could provide some support, I think, to those markets as well. And last but not least, I think Donald Trump, it really provides a boost in confidence in investors. You really can see in the Wall Street, the deal making, the outlook has turned significantly better. The CEOs are more optimistic. That is fundamentally a good backdrop, I think, for equity market, for risk taking in general. And lastly, of course, AI is still going to boom in our view. But as I said, if you're buying an index, maybe you should have a bit of a think on whether you're getting enough diversification.
As ever, it's an absolute pleasure to have you on. Thank you ever so much for your thoughts and your time. And we look forward to welcoming you back again at some point in the future. Thanks, Janet.
Thank you. Thank you.
Thanks, everyone. Bye-bye.